session that we are about to dive into will explore best ways to reform the global tax system for greater transparency as well as tax compliance. This is panel 4, Reforming the Global Tax System. Our moderator for this panel is Juan Carlos Hidalgo, policy analyst, Costa Rica. Please make him welcome.
How are you? I want to invite our panelists, please, to join us to the stage. We're going to have a very lively conversation about the reforms that have been discussed at the G20 and the OECD about how to implement a global minimum tax. We have 1 hour for discussion, so I'm going to keep my interventions short. I just want to introduce our panelists by name. You can go into the website and look at their extended bios. Starting from my left, we have Mr. Scott Hodge. He's the president and CEO of the Tax Foundation in Washington, D.C. Then we have Mr. Pascal Saint-Amans. He's the director of the Center for Tax Policy Administration at the OECD. Then we have Mr. James Sun. He's director of investment and enterprise at the United Nations Conference on Trade and Development. Then we have Mrs. Cynthia Kennewendo. She's an African economist and former Minister of Investment, Trade and Industry of Botswana. Then we have Emilio Pineda. He is the chief of the Fiscal Management Division at the Inter-American Development Bank. And finally, Mr. Martin Ibarra, who is the CEO of Araujo Ibarra International Trade Consultants in Bogota. So welcome to the panel. We're going to start with short interventions, 3 minutes each, starting with Mr. Pascal, who is going to explain to us what's exactly being discussed at the OECD regarding this minimum global tax.
Thank you, Juan Carlos. Good morning to you all. Very happy to be here, even though I'm probably the messenger of a message that you may not want to hear, so please don't kill the messenger. That's the first request. Second, and very quickly, as we have little time, try to explain to you where we come from, where we are, what's next, and I think what I'm going to say has a very significant impact on what you're doing, and that we should be working on that together. Tax is at the core of sovereignty, and for a century, each country would act unilaterally with its own domestic system. But of course, with globalization, and you are a demonstration of that, there have been something like tax competition to attract investment. In particular, mobile investment, but not only mobile investment. This tax competition has resulted in free trade zones, in tax incentives here and there, and also in the exploitation, the use of many loopholes in international tax rules, which were designed by the League of Nations, by colonial powers 1 century ago. The global financial crisis hit the world in 2008 and acted as a wake-up call for the world, for governments of the world, to say globalization is going to be rejected by our people if we don't fix the problem of international tax, which has resulted in a race to the bottom, which has eroded the revenue of governments and the trust of the people in the tax system, because the big guys go away without taxes and the small guys face GST, VAT, and other taxes. As a result, the global community, under the leadership of the G20 and with the OECD acting in an inclusive manner with 140 countries in that case, have acted. And they took a number of actions. The first one was putting an end to bank secrecy, which is not our topic. Second was to deal with base erosion and profit shifting, fixing the League of Nations rules and update them so that to benefit from tax benefits, a company would have to have substance in a country. That's the BEPS work. But countries were still unhappy, and they decided to act following what the US tax reform did in 2017, which was to introduce a global minimum tax. I emphasize the US move, which is called GILTI. There is nothing guilty about that, but it's about global intangible low tax income, which was introduced by the Republicans who are not big lovers of tax, but they said, we need to put an end to the race to the bottom. The rest of the world say, we need to do it. And together with a negotiation on how to tax the digital economy, they decided to establish a global minimum tax, known as the GLOBE rules, known as Pillar 2, which provides for what? It provides for a minimum of 15% effective rate for all companies across the world. Actually, the companies, the turnover of which is above 750 million euros. The large multinational companies, we estimate the number around 8,000 companies. Even though this threshold could be lower depending on what each government will decide. What's the mechanic? The mechanic is that you have 3 layers. The first layer is an income inclusion rule, which means that the country of residence of the multinational companies will look at the effective tax rate, effective being the financial account and the tax effectively paid, and you look whether it's above or below 15%. And if it's below 15% in one country, the country of residence will take the difference between the effective tax rate and 15%. If the country of residence doesn't do it, the country of source will do it. It's called an under-tax payment rule. But if neither of them do, or if both of them do, the country where there is the low tax, because there is a free trade zone, because there is a tax exemption, because you're a zero-tax jurisdiction, can decide to take the 15%, and that's what we call the qualified minimum tax. QMDTT for the terrible acronym, or top-up tax if you want. Which means that we are heading to a world with a minimum tax of 15% effective. There are only 2 exceptions. One is what we call a carve-out. Will be carved out from this minimum tax a return of 5% on payroll and 5% on assets. And for 10 years, actually, it will start at 10% on payroll and 8% on the assets, and will go down to 5% after 10 years. That's one exception, or one mitigation to this minimum tax. The other one is a pure exception. That's for shipping. International shipping is not. All the other activities are in. It's a brave new world, which is going to be shaky for your environment, and I think we need to think collectively about that. I'll come back later on what the next steps are in terms of move by countries.
Thank you. Mr. San.
Thank you very much. I think Pascal, as the architect of the global minimum tax reform, has already explained the rationale. That's from the tax perspective and the development perspective. What I'm going to talk about is the investment perspective. So what is the implication of these tax reforms for investment flows and investment policies? So this is the perspective. First and foremost, I just wish to say that the UNCTAD's position on the global tax reforms, and we support it. We think it's important. We put into the development context, as we are a development organization, meaning that this is important means of mobilizing resources for development, which is in dire need. And secondly, this will also try to avoid this competition, tax competition, raising to the top of incentives that has been there, which is harmful as we see it. Our perspective is that once the tax reform is putting in place, what the investment policymakers should do, and first and foremost, what it would be impact. To cut the long story short, we see that there are the impact on investment flows in the sense of the volume and in the sense of pattern. In the sense of volume and in the sense we see that this impact will not be that big in terms of global FDI flows. So it's roughly about 2% of kind of downward pressure. And taking into account of the volatility, the lumpiness of global investment, and then that is not very much in terms of negative impact on global FDI flows. Now, in terms of the pattern, we see that there will be a kind of diversion effect, that traditionally that countries have higher level of tax. We talked about, Pascal talked about effective tax rate, and we also looked further the FDI, profit shifting related effect. So the effective tax rate adjusted by FDI levels will be much lower. So there will be some kind of effect, and investment may go to the traditionally higher tax level countries. That's what we see. In general, both developed and developing countries will benefit from the investment diversion effect, but some areas, perhaps in this area, this region, there will be a kind of impact. Investment flows may not be as high as in the past. That's for the obvious reasons that you know. Now, in terms of the policies, we see that there needs kind of significant policy adjustment for countries. That is investment policies, incentives, which has been a kind of strong policy instruments for achieving industrial development goals. So if you look at industrial policies, at the moment we see that over 100 countries have actual industrial policies. And these industrial policies use investment as an instrument for achieving the industrial policy objectives. And in the investment policies, we see that incentives is a major kind of a policy tools. So all these needs to be adjusted in line with that. And this is not the first time, by the way. If you look at history, I have to say this is the third one. The first one was already in the 1990s when WTO reached agreements on the agreement of subsidies and countervailing duties. That impacted also on special economic zones in terms of subsidies. And we worked with WTO to provide capacity building in countries for that first wave. And the second, of course, is the BEPS 1, and now we get to the BEPS 2. The key challenges for policymakers is really to understand what is the red box that is countries need to change and they should no longer do. What is the orange box, maybe to see how to adjust. And what is the green box? There are still incentives, schemes that is possible for country to use as an important tool of attracting investment, particularly for sustainable development. So there are flexibilities, and the whole design we looked at has a lot of flexibilities for countries to take. Countries have to understand the flexibilities and try to use that for achieving sustainable development goals while in compliance with the reforms.
Thank you.
Thank you.
Thank you, Mr. San. Now we're going to have the opinion of Mr. Scott Hodge.
Thank you, Juan Carlos. I appreciate it. Let me come at this in a little bit different perspective. The great economist Thomas Sowell once said, "There are no solutions, there are only trade-offs." And in that spirit, I'd like to encourage members of the OECD's inclusive framework to ask themselves what's more important for the long-term health of the global economy, a marginal increase in corporate tax revenues or economic growth, because these goals are not compatible. In a landmark 2008 study, economists at the OECD determined that the corporate income tax is the most harmful tax for economic growth, because capital is the most mobile factor in the economy and thus the most sensitive to high tax rates. And they encouraged countries to change the mix of their tax revenues away from income-based taxes to more consumption-based, broad-based consumption taxes or property taxes. Well, today, the OECD sees it a little bit different. It is encouraging countries to establish this 15% effective tax rate and to change the way some corporate tax profits are taxed to the country in which their customers are, as opposed to where their headquarters are. While the politics of the corporate income tax have changed dramatically over the last 14 years, the economics have not. We should be very, very careful, I think, in putting government's need for tax revenues over the needs of the global economy. In our perspective, a global minimum tax will raise the cost of capital, put sand in the gears of cross-border capital flows, and impact FDI. And while the justification for this global minimum tax is to make corporations pay their fair share, we have to remember that economic studies have shown that if you look at who pays the economic burden of the corporate tax, it falls on workers through lower wages. And the parties that are most harmed by this are marginal workers, such as women, low-skilled workers, and younger workers. Secondly, a global minimum tax will almost certainly increase the cost of compliance for corporations, and it will increase the administrative costs for countries, especially small and developing countries. And we need to estimate what those costs are going to be before we move forward. But by creating a global tax cartel, the global minimum tax also threatens the sovereignty of small exporting countries that rely on tax competition to be competitive with larger countries with bigger populations and more natural resources. Before finalizing its work, we believe that the OECD should update its 2020 impact assessment with new data and updated to the 15% rate. That's why we're pleased to see UNCTAD's recent report, as James had just mentioned, that indicates that Pillar 2 will increase overall corporate revenues by about 15% globally and reduce the FDI by about 2%. Now, that may not sound like a lot, but last year, global FDI was at a lower level than it was 10 years before in 2011. Do we really want to put more added pressure on global FDI through this kind of a tax? Policymakers need to give more attention to the economic consequences of these policies and not focus solely on the revenue effects, because more tax revenues really can't compensate for a shrinking global economy. Let me just conclude. You're probably asking, so what does this mean for free trade zones or free zones? Well, in our view, free zones violate the principle of tax neutrality because you offer special tax breaks for some taxpayers over others. What we would rather see is countries move toward broad-based tax reform that create a neutral, competitive climate for all of your taxpayers. Now, we happen to think that the Estonian tax system is the most neutral and most competitive in the OECD, and we'd like to encourage you to move in that direction. But each country is going to have to decide for itself what makes sense for its constituents, its residents, and its economy. Thank you very much.
Thank you, Mr. Scott. Mr. Hodge. Now we're going to have the remarks from Mrs. Kennewendo.
Thank you very much, and a very good morning to everyone joining us today. You know, I find myself in a very conflicted position. First, as a former policymaker, having been in the Ministry of Investment, Trade and Industry, it would be a relief to no longer have to have this race to the bottom. But having had that experience, you know, it can easily be argued that there are other incentives that countries can use in order to attract FDI. And trust me, we had it. Good governance, stability of economy, access to markets, connectivity to other countries, access to about 250 million population in the region, and so forth. And yet, if we leave out the tax incentives, Botswana only manages to attract about less than $0.5 billion of FDI a year. And when we look at the data, every country that has good governance, good doing business reforms, all of that, in Africa specifically, they all attract less than $0.5 billion of investment per annum. So the question is, when you take away the tax incentives, how do we increase more, increase investment into these countries? What becomes the selling point? And again, I'm speaking from experience. When you look at Botswana, we had a very stable tax and macroeconomic policy. So our starting point would be maybe 5% for the first 5 years and then 10 to 15% thereafter. And that rendered us uncompetitive to some other countries. And I'll give an example. In 1 year, we were all vying for the same company, 3 countries, for the same company. In terms of softer incentives, we were the best. Good governance, stability, all of that, expatriation of profits and so forth. And yet, we didn't make it because other countries who won, that investor offered lower taxes. So this is from a policymaker's perspective that you have to bend over backwards in order to get the investment. And when you don't, there are also other issues of political expediency. We can talk only about economic issues, but the reality is there is political expediency that is needed for policymakers. So that's the one side. But on the other side, as an advisor, it's great. Countries have to also deal with domestic capital mobilization. Taxes are very important in government revenues and adding towards development and so forth. And this could ease the discussions between the ministers of trade and the ministers of finance and potentially reduce the debates that we used to have. But at the end of the day, when we look at this proposal, the way it appears is if the threshold is at $750 million for company investment, then maybe it doesn't actually affect African countries. Because in average, and I was giving an example earlier to Pascal, in average, some of the companies we used to get in Botswana were about $10 million. So maybe, I know they are actively in the discussion, but maybe some countries are in the discussion just to see what the future looks like, but not necessarily to actually actively participate, and maybe the special economic zones might not be affected after all. Thanks.
Thank you. Now we're going to hear from Mr. Pineda.
Thank you. Thank you, Juan Carlos, and thank you very much for the invitation to be in such a distinguished panel. I will bring the perspective of Latin American countries and economies and governments, and I would like to make 3 points. The first one is that the vast majority of Latin American and Caribbean countries are members of this inclusive framework of BEPS that Pascal was referring to, and therefore have signaled their intention and commitment to implement the Pillar 2 or the framework for this global minimum tax. And the regional consultations that we had so far with countries in the region, they have reaffirmed their intention to do it. And our expectation is that particularly if the larger economies in Europe and the US move forward, the vast majority of economies in the region would move forward with the implementation and with significant advances in this implementation by 2023. So that's the first point that I would like to make. The second one is that the main policy decision dilemma that governments in the region have is not whether the multinational enterprises operating in their countries will pay this global minimum tax or not, but whether they would like to participate from this additional revenue. And let me expand a little bit. As Pascal explained, the way the Pillar 2 is set up is that regardless of what the Latin American or Caribbean countries do, the multinational enterprises operating in the region will have to pay more taxes, most likely to the countries where the parent multinational companies are located, essentially European countries, the US, Canada, or Japan, meaning OECD developed economies. They are the ones that, in principle, in a baseline scenario, would benefit the most from the potential additional revenues. However, the Pillar 2 already established the mechanism for which the governments in the region could make those additional revenues remain in the region. And that's which, through the instrument that Pascal already mentioned, which is the qualified domestic minimum tax. And that's the way through which the countries in the region would be able to bring the effective tax rate to the 15%, and by those means retain the revenues in the region and not allow that the revenues go abroad. So I think this is an important point. The policy decision that governments will have to face is not whether the enterprises will pay more taxes or not, because that would be decided by the Pillar 2, especially once the large economies implement it, but whether they want to participate or not from those additional revenues. The different estimates from the OECD, and also we've done some estimates, put it as potentially very significant in the several billions of dollars. And the third point that I would like to make, and my final point, and it's in line with what some other speakers have made, is that moving forward, assuming a complete implementation of the Pillar 2, then probably our countries in the region, in order to attract investment, will have to place less emphasis on tax incentives and place more emphasis on other structural factors, such as logistics, human capital, and trade facilitation, red tape, and issues of that sort to make them themselves more attractive and differentiate from different countries. These are obviously not easy things to accomplish, making logistical operations more efficient, achieving a stable political and business environment, and enhancing human capital and reducing red tape are not things that can be done overnight. But clearly, the emphasis and the plan for the middle run and the long run has to be centered around those more structural factors. And those will be the main means through which the countries will be able to attract investment and differentiate themselves. And those will be my main points. Thank you.
Thank you. Finally, we're going to hear from Mr. Martín Ibarra.
Thank you, Juan Carlos. Well, first, it's a real honor for me to be in this historical panel. First time that we are speaking about corporate tax and free zones. And I think I agree completely with James. We are in front of the second tax revolution in the world in the last 30 years. The first revolution was with the approval of the WTO. Because in that time, 30 years ago, the free zone was export-oriented. That means the incentives of the free zone was proportional of the export to the country. That means if the company export is exempted, if the company sale to the local market, well, tax it. And here are two persons. One is Juan Torrens and Elson Braga. I ask Juan and Elson to stand up, please, so the public can see each other. Please, Juan, stand up, please. Juan used to be the president of the World Free Zone Organization 30 years ago, and Elson was a member of the board with myself. And at that time, we are only thinking in exports. And when the WTO was approved, we have to change the regulation, but especially, we have to change the mind. Now it's forbidden to incentivize export through free zone in income tax. For that reason, the most of the legislation in the world have to change. And the export incentive was erased in the world. For that reason, the World Free Zone Organization do not have the name export in his name. And now we are in the second revolution, the 15% global minimum tax. And I think it's a good idea. It's a good idea because it's fair that the countries that are producing the substantial activity will receive some taxes. And if the multinational is paying in some countries some percentage, why not are paying some of that part in the country that is really doing the business? For that reason, I think all of the free zone in the world have to begin to change the mentality and the laws and regulation to adapt to this, not for a company, for the big companies, that do not have anything to do with the medium and small company who are maybe the 80% of the company who works in the free zones in the world. But I think it's very important. And the second thought that I want to share with you is the essence of the free zone is the import duties. Because as you know, when the GATT was approved, there was 50 free zones around the world. When the WTO was approved, was 500 free zones in the world. And James told us that today are 7,000 free zones in the world. It's an explosion of free zones. Why? Because the concept made in the world. And when you have the concept made in the world, you have neutral spaces. You need neutral spaces free of import tax and sales tax and procedure to allow to jump the spare part from one country to another to intermediate goods and final goods and logistics. And if you charge import duties, sales taxes and procedure to those goods, you break the concept made in the world. You break the concept of value chain or regional value chain that today is enforceable. For that reason, free zone is more than corporate tax, and do not have to do anything with corporate tax. Have to deal with import tax, with sales tax, and with import and export procedure. If you see, for example, Juan Carlos, in the world, the two main exporters in the world with high free zone, China and the United States, they have full corporate taxes in the free zones. China in 2008 raised the 15% of corporate tax in the special economic zone to 25%, and the rest of the country down from 30 to 25. And the United States, and here representative of Foreign Trade Zone Association, is full. The corporate, for that reason, free zone is more than corporate tax.
Okay, thank you, Mr. Now we're going to have a first round of questions. I'll ask the speakers to keep it short, up to the point, so we can have several questions for each speaker. I'm going to start with Mr. Pascal Sangaments. You mentioned that there is a race to the bottom regarding corporate tax rates. And if you look at the OECD since 1980, the unweighted average of corporate tax rates have come down from 45% to below 25%. But at the same time, government revenue as a percentage of GDP has risen from 30% to 35%. So it doesn't look like cutting the corporate tax rate has affected government revenues.
You just forget a basic of tax, and it's striking because everybody talks about the rate. A tax is the product of a rate and a base. So saying, oh, you have a trend on the rates and therefore, and you don't have a tax revenue which is diminishing, so there is something wrong. Look at the base. And the base has grown massively with globalization. There should have been an increase of corporate income tax revenue. And by the way, you have a number of people who have incorporated due to that. So instead of being at personal income tax, so the delta should be even bigger. So that's an easy question to answer. Don't be myopic and look at the rate and the base. Scott said it. What matters is for policymakers, a broad-based system with a low rate. By the way, broad-based system means that you cannot have loopholes like tax exemptions. So that's maybe the only contradiction you had in your presentation. If you want to reduce the rate, you need to have a broad base, and broad base means you don't have exemptions, right? So no, I think that's not really the question. The question, I think, for you, and I mean it, so I'm not here to say, oh, the world has changed and do what you can, but think strategically, think with us. We're happy, and when I say we, it's the OECD Secretariat, we serve 140 plus members from the Global South, from the OECD countries, from the G20. They took a decision, and the decision was really agreed and now is being implemented. So the question is not whether we like it or not. I fully understand and have sympathy for those saying, well, why this? And we don't like it. But it's a matter of fact. And there are good reasons for that. We can go back to them. But what matters, I think, is how do you operate in that new world? What does that mean? What are the tools you can use? What's the consequence on your ability to attract investment? I think the UNCTAD report, which is a very good report, as well as the IMF surveys, as well as our own impact assessment, show that paradoxically, the impact on investment is quite small. And it's not the trade-off, I think, as described by Scott earlier. So what's the impact on you? How will you operate knowing that? And I will conclude with this. Things are moving fast. I expect the European Union to pass a directive on Friday, in Tuesday's time, to implement the minimum tax by the 1st of January 24. We'll see the US, whether the US moves or not, but with the first mover, it's something like domino effects. All the countries will move. All G7 countries announced they will move. A number of G20 countries announced they will move. A number of zero-tax countries have announced they will move. A number of very attractive tax countries have announced they will move. Let me name names: Switzerland, Singapore, United Arab Emirates putting in place a corporate income tax at 9% with a minimum tax at 15% for the in-scope companies. What will you be doing? What are all the consequences? I think that's something that we, Secretariat of the OECD and the Inclusive Framework, are happy to work with you to see what the consequences are and what's the new modus operandi.
I want to dwell on that, Mr. San. You mentioned that your report found that there will be a 2% downward pressure on flows of investment globally out of this tax. But we're already facing talks about deglobalization. Isn't it ominous to introduce a policy that is going to aggravate this phenomenon of deglobalization?
Thanks, Juan. I think you put it into a very big, broad context now, challenging for that. But first, I just wish to start with Scott said, no solution but trade-offs. If trade-offs is the reality, if the reforms, as Pascal said, will be agreed by the countries, and they are all, by the way, they are all member states of the United Nations, so we have to follow it. Then all those concerns and all those the potential impact that Scott highlighted, we need to address and to minimize the potential negative effects and to maximize the potential benefits. So that is the key challenge, I would say, if the decision of the member states to go for this reform. Then if that's the case, what should be done in this perspective? I thought there are several dimensions. One is that we need to have a kind of close dialogue between the tax policymakers and the investment policymakers and industrial policymakers to see the synergies between the two sets of policy forces and to see the coherence of the policies. And that communication needs to be strengthened. Recently, we produced two papers. One is what the investment policymakers should know about the tax and tax reforms, and also what the tax policymakers should know about the investment reforms, about the investment policies and the investment treaties. Just to give you an example about the international investment agreements, in most of the investment agreements, the definition of investment and coverage, they do not exclude tax policy measures. That has an implication for the constraints of countries that have signed these 3,400 bilateral investment treaties, regional treaties. There is a constraint for them to change their policies that are related to tax. And that constraints need to be addressed. Otherwise, because a number of the treaties have this investor-state dispute settlement mechanisms, investors can take the governments to the International Arbitration Tribunal because they feel that the policies have affected them. So that's a major concern at the moment of the investment community, how to address that. Just give you an example. So that is one. Others, capacity building for countries to top up to the 15%, particularly developing countries. They do not have the capacity, they don't know how to do that. So we need to help the countries to do that, so that to avoid that the tax, this tax reforms will benefit the source countries, but not the countries of the destinations. There are many other things that can be done in this area.
Fortunately, time is our biggest enemy right now. Mr. Hodge, you live in Washington, D.C. I want to hear a little bit about the politics of this, because we have a midterm election coming in November. What's the legal framework for this deal to be passed in the U.S. Congress? And is there any chance that that will happen before November or after November if the Republicans wins the majority in Congress?
Well, thank you. I certainly don't see anything happening before November at this point. We have, I think, a wide gulf in the way that the White House views this issue and where it's trying to move the issue, and where the U.S. Congress, both in the House and the Senate, are less enthusiastic, to put it mildly. And so I think that until we bridge that gulf, I don't see things moving forward. A lot of folks that I talk to in Congress are quite concerned that they have not seen the kind of impact assessment, especially on the U.S. tax base, that they would like to see. They don't think that Treasury has been as transparent with that information as they'd like, and I think that that's a big concern. And ultimately, we have not had a robust debate in the U.S. Congress about the effects on both the U.S. Tax base, the fisc, but also on U.S. competitiveness. And there's a great concern about what this might do to U.S. competitiveness in the wake of the 2017 reforms. And until we have those answers, it may be difficult to move this forward.
Thank you. Mrs. Kennewendo, only 23 African countries have signed to the inclusive framework. Why do you think that's the case?
Well, I think it just brings us back to what I mentioned earlier, but there's also a bit of a skepticism around the distribution of benefits. As has been discussed, it's expected that there will be a windfall of revenue generated from this tax. But I think it's the Tax Justice Network, I believe it is, that put out a study last year saying over 60% of the benefits would go to the most developed countries, while 40% would have to be split among the developing countries. For example, Latin America is only expected to have to benefit out of that pie, maybe 13%. So the real question is this another one way of disenfranchising developing countries? And I say this, I discussed with Pascal, is because the proposal comes on the face of FATF attacking developing countries for being tax havens, when Switzerland, Ireland, the US have lower tax regimes than Botswana, Mauritius, Cape Verde, and so forth. And in addition to that, it comes on the face of talking about COVID financing and the SDR allocations, which when we looked once again, the demand for finance came, SDR was unequally split. Countries that needed more received less. So I just think that the proposal came in the face of all these other financing for development challenges, and that could be one of the reasons why we only have about 23 countries. But quickly on what I was talking about earlier, that countries would need to also be more creative in how they attract investment beyond taxes. You know, when we what James said earlier, that investment policymakers and finance policymakers would need to be in a much better debating room. the reality of the matter is, we used to argue, if I attract a new business into the free zone or a new business into the country, as the Minister of Investment, you are not actually losing any tax because you never had it in any case. But that's an investment policy argument. You never had it, but we are bringing jobs. We're going to bring more capacity for taxes and payee incomes and in the economy. And so we need to be focused more on developing the country, having more diversification and so forth. So hopefully, James, this can have us sitting and have better discussions on what truly is a better trajectory for economic development, because at the end of the day, that's what we're looking for, and attaining those development goals. Thanks.
Thank you. Mr. Pineda, you mentioned that, again, correct me if I'm wrong, the main benefit from this reform is that governments in Latin America will have more revenue out of this, but not necessarily giving more money to governments with a very bad record of efficiency and corruption is a good thing for Latin American countries. Is there any other benefit out of this in terms of economic efficiency, let's say?
That's a very good question, and let me clarify what I tried to say in my previous intervention. Not the main benefit, the main policy dilemma that the governments have in the region is to participate or not from these additional revenues. As Ms. mentioned, if the governments in the region do nothing, the vast majority of the additional revenues would go to the developed economies, and no additional taxes would essentially remain in the region. So that's why in the short run, the main policy dilemma they face is to whether they decide to participate from these additional revenues or not. And that's through the implementation of this qualified domestic minimum tax. And by those means, those numbers that were mentioned, that 60% of the benefits would go to developed economies, the countries in the region would be able to alter that share and retain some of the benefits. So that's the policy dilemma in the short term. However, your question is very good about the medium term and the long run. So is it good for governments in the region to have additional revenues or not? So definitely, and this goes back to my original point. So the need and the urgent need for countries in the region to become much more efficient in all realms. For instance, on the tax front, we do believe and strongly believe that countries in Latin America and the Caribbean have a large scope to make their overall tax systems more efficient. And that means bringing down the corporate tax rate that affects the entire economy and widening the base. It makes sense, as Scott mentioned, to try to to lower the tax rate for the entire economy and not only giving tax incentives for a selected few. That has a potential significant impact on economic in the long run. And the governments need to become much more attractive to investment by making structural reforms that go from enhancing their infrastructure, reducing their logistical costs, reducing red tape, becoming more efficient, enhancing human capital. It's a long agenda. But when we make surveys in Latin America and the Caribbean about what are the main reasons why companies go to invest to different countries or not, tax is one of the factors, but it's typically not among the top of the list. You have other more structural factors that those are the ones that need to be addressed urgently. So those factors of stability, of cost, of the availability of human capital, of transportation costs, those are the ones that are crucial for the region to become more efficient. So that goes to the point. Can you improve the infrastructure of a country without having sustainable public finances? So I think it can become a virtuous cycle instead of a vicious one.
Thank you. Mr. Ibarra, as far as I understand, this global tax will apply to only 100 companies globally, companies that have a revenue over 750 billion euros. What will be the impact of this tax on free trade zones in Latin America?
I think they won't have any impact. And if they have an impact, the impact will be positive because Latin America today is in the half of the per capita of export in the world. The world export per person is $2,500, and Latin America is $1,250. And the big challenge in the region is to reach the world per capita. That means we have to duplicate the international business. We have to duplicate the export, as Emilio said just before. And the free zone is the secret tool that the region has to attract new business. The International Development Bank last week in Los Angeles Summit of the Americas said that the nearshoring is going to bring $72 billion in investment and export for the region. And if you, through the free zone, bring more investment and build more business, you are going to create more taxes. There are some countries, for example, Dominican Republic, and here we have a very good delegation of Dominican Republics, that said even if the company in the free zone is fully exempted of income taxes for some years, the impact of the economy is $1 you reduce in the free zone company, create $10 in new taxes in the economy. 1 to 10. For that reason, if we want to create more taxes, we have to create more business and more export and more employment in the region.
Thanks. Mr. Pascal, you mentioned the time frame a little bit. You said that on Friday, the EU is going to assign. I think I read this morning a story that Hungary is not necessarily in when it comes to the agreement. What's the time frame of this? Initially, it was discussed that it will be enforced by 2023. It doesn't look like that's going to be the case.
The draft directive has already provided for the entry into force to be 24. And I think everybody agrees Switzerland has planned for 24, so I think 24 is when this will enter into force. We'll see what happens on Friday. As long as it's not voted, it's not adopted. We hear many things. You can read stuff in the press and elsewhere, so we'll see. Again, what matters is the idea of the first mover. But I think for you, the takeaway, I think, to be cautious would be it's going to happen, because the likelihood of this to happen globally is 99%. So better prepare than hoping that Hungary will block at this ECOFIN. And by the way, for being close to the negotiation, I can tell you that what is at stake in the EU has nothing to do with the tax deal. It has to do with recovery funds and other things. By the way, in the US Senate, Senator Manchin, who blocked the Build Back Better, didn't block it because of this provision. He blocked it for other provisions. So this is likely to happen. It's not wishful thinking. I think it's the cautious approach for you. And you'd better get prepared, think strategically of what that means. And again, happy to work with you on that.
Well, thank you. Unfortunately, I've been told that we run out of time. I was expecting more questions, even from you, the public, but the speakers are going to be available afterwards, so you can approach them and ask them if you have any questions. Thank you very much for joining us, and see you around.